Hello guys, welcome to Cafe Simplify, and we are diving into finance for economics. Always remember to like, share, and subscribe. Question number one: explain what you understand by the term financial market. 2 marks. The financial market is a place where buyers and sellers come together to trade financial assets with varying maturities such as stocks, bonds, currencies, and commodities. It facilitates allocation of resources, risk sharing, economic growth by enabling investors, businesses, and governments to raise capital. Differences between key terms in financial economics: a zero coupon bond versus a coupon bond. We see that a zero coupon bond, which is also known as discount bond, discount bonds, is an instrument or an instrument under which a borrower promises at a current time to pay a one specified nominal sum to the lender at a specified future date. So we see that in this zero coupon bond, this is an instrument or instruments under which a borrower promises. So at the time, these are bonds or instruments where at the moment of acquiring these instruments, the borrower promises at that time to pay a specified nominal sum to the lender at one specified future date. So here the borrower promises to pay a specified nominal amount or sum at some other time, but at once. That is a zero coupon bond instruments under which borrowers promises at the current time you promise them to pay one specified nominal amount, yeah, nominal sum to the lender at one specified future date. So at that current time you promise, but you also specify when you will pay back this sum. Then we have a coupon bond. So we see that these are contractual agreements by the borrowers. Contractual agreements by the borrowers to make regular payments until a specified date when the whole amount is to be repaid. You take them like repaying in installments, like if they were demanding you. So we see that in first of all are contractual agreements. That means between two people, but it is the borrower who makes this agreement, and he is going to make regular payments until a specified date when the whole amount borrowed is repaid. Say he has borrowed 1 million, so and he's going to pay 20,000, 20,000, 20,000 for a specified date until when the whole amount is repaid. Then organized exchange versus over-the-counter markets. So we see that organized exchange markets are financial markets where standardized financial instruments such as stocks, bonds, options, and futures are bought and sold by investors according to a set of predetermined rules and regulations. So whenever you hear organized, what should always run to your mind? A set of predetermined rules and regulations. So those are what we call organized exchanges. Then we also have over-the-counter markets. What are over-the-counter markets? We see that over-the-counter markets are decentralized financial markets where financial instruments such as stock, bond, derivatives are traded directly between parties without the supervision of a centralized exchange. So you see in this over the counter, there is no supervision of a centralized exchange. These are financial markets where financial instruments such as bonds, stocks, derivatives are traded directly between parties without supervision of a centralized exchange. Money market versus capital market. We see that a money market refers to a financial market where short-term securities are traded among investors. That is where what we call the money market. It involves short-term securities. Then the capital market refers to a financial capital market refers to the financial market where long-term debt, equity, securities are traded among investors. So capital market, for it is long-term control, while money market is short-term. Then treasury bills versus treasury bonds. What is a treasury bill? These are also known as the T-bills. We have T-bills and T-bonds. So treasury bills are short-term government securities, maturities of weeks to a year, issued at a discount to finance its operations. So we see that these are short-term government securities, maturities of weeks to a year, 365 days, issued at a discount to finance its operations. So whenever a government wants to finance its operations, it will sell or issue out treasury bills. Then we have treasury bonds. We see that for them, they are long-term government securities that pay periodic interest. So treasury bonds are long-term government securities that pay periodic bonds that pay periodic interest. Treasury bonds are long-term government securities. That is maturity about, when we say long-term, we mean maturity about 10 years. That pay periodic interest. Differentiate between these two. Retail certificate deposit versus negotiable certificate of deposit. So we see that retail certificates are small in value saving instruments that are used. Let me come again. Retail certificate of deposits are small in value saving instruments issued by the banks to individual investors within fixed interests and maturity dates and are not traded in the secondary markets. So it's that retail certificate of deposits, first of all, are small saving instruments. They are issued by the banks to individuals with fixed interest rates and maturity dates are not traded in the secondary market. Yeah. Then we have negotiable certificate of deposit. These are large value certificates of deposits which are bought and sold any number of times until maturity. Whoever is holding it at maturity receives the face value. That is what we call retail certificate of, that is what we call negotiable certificate of deposit. We said sold at any time until sold at any number of times until maturity. That means whoever is holding it at maturity receive its face value. Capital, 5 functions of financial market, and we looked at them in some video. But we have capital allocation, which channels funds from savers to borrowers. Then we have price determination. C establishes prices and securities through supply and demand. Liquidity provision allows investors to buy and sell securities easily. Liquidity provision. Then we have price risk sharing, facilitates risk sharing between lenders and investors. We've said liquidity provision allows investors to buy and sell securities easily. Another one is information aggregation and coordination. Financial markets act as collectors and aggregators of information about financial assets, value, and flows of funds from lenders to borrowers. So we see information aggregation and coordination, risk sharing, liquidity provisions, allows investors to buy and sell securities easily, price determination, capital allocation, borrowing and lending. Financial markets permit the transfer of funds from one agent to another, either for investment or consumption. It is also an important function of financial markets. They also promote efficiency, where financial markets reduce transaction costs and information costs. Financial markets reduce transaction costs and information costs. Sometimes information costs, yeah, but if you're in the financial markets, it will always be readily available for free. Come to our last number. Differentiate between annuity and perpetuity. You see that an annuity is a finite set of level sequential cash flows that provide the cash flow over time. Is a finite set of level sequential cash flows that provide regular cash flow over time. So we see in this annuity you pay, it is finite. Yeah. When you've completed it, you end there. It is a finite set of sequential cash flows. You pay them in a certain range, but until when you complete paying them, that is the end. Then a perpetuity is actually an example of annuity. Yeah, it's a type of annuity that continues indefinitely. Yeah, so an annuity has a time bound, it is finite, while a perpetuity continues indefinitely. Four key elements of a market determined interest rate. Four key elements of a market determined interest rate. We have risk premium, that is compensation for default risks. Yeah, and this interest market determined interest rate, they will always have risk premium where they will compensate you for certain type of risks. We call them default. Then inflation expectation, higher inflation, higher interest rate. It is a key element. Then liquidity preference. Investors demand higher rates for less liquid assets. Investors demand higher rates for less liquid assets. Yeah, those assets which cannot easily be converted into cash form. They have higher rates. Investors demand higher rates for less liquid assets. Then central bank policy affects rates through monetary policy. Those are the elements of market determine the interest rates. Central bank policy, liquidity preference, inflation expectation, risk premium. Meaning of derivatives. Meaning of derivative instruments with examples. So we see that derivatives are financial contracts whose value depends on the underlying assets. An example, future contracts. For example, trading companies like oil, options, yeah, call and put options on stocks or swaps, interest rate swaps. Derivatives are financial contracts whose value depends on the underlying assets. Examples, we have future contracts and options. Yeah. So we come to our last number called talking about or examining capital budgeting. And the definition of capital budgeting. See that capital budgeting is the process of planning and evaluating instruments in the long-term projects, such as purchasing new machinery or launching new business ventures. Capital budgeting is the process of planning and evaluating instruments in long-term projects, such as purchasing new machinery or launching new business ventures. That is capital budgeting. Explain the following terms in capital budgeting. Conventional cash flows. What are conventional cash flows? We see that these are cash flows where initial outflow Yeah, you invest in once is followed by positive inflows. Then you start harvesting positively. That is conversion cash flows, where an initial outflow, it is an investment, how much money you are putting out as capital, is followed by positive inflows. Those are the profits now you're now getting. Then mutually exclusive projects. These are projects where selection of one project means rejecting others. If they are mutually exclusive, that means the opposite is independent. Yeah. And if projects are independent, that means one project can run and the other one can run, one not affecting the other. But mutually exclusive projects, but here in mutually exclusive projects, these are projects where selection of one project means rejecting the other. That is mutually exclusive independence. This one can run and the other one also runs. They are not affected. The opening up of this one does not affect the other. That is in independent projects. What is capital rationing? We see that capital rationing is the restriction on the amount of capital available for investment, requiring firms to prioritize projects. So the government might decide to do, or a company might do, capital rationing, restriction of the amount of capital available for investment, requiring firms to prioritize certain projects, that is capital rationing. Then why companies engage in capital budgeting? We see that they are always trying to maximize shareholders' wealth to ensure optimal allocation of financial resources, to evaluate profitability before making investment decisions, to manage financial risks effectively. Then steps taken in capital budgeting, therefore, first one is generating ideas. These ideas are generated from stakeholders, workers, and well-wishers. Secondly, analytical individual proposal, gathering information and evaluate the profitability, cash flows, that is analytical. So these ideas are generated, we gather them and we analyze these analytical individual proposals, gathering information and evaluate profitable cash flows. Then planning the capital budget. Here, organize the proposals that fit in the company's budget. After getting all those proposals you've analyzed, now we organize the proposals that fit in capital budget. It means we start working on it now, planning and capital budgeting. Then lastly, monitoring and post-auditing. Replace wear and tear, expansion projects, venture into new products and services, selecting projects based on financial strategic fit, selecting projects based on financial and strategic fit. Yes, that is monitoring and post-auditing when the firm or the industry has finally kicked off. Otherwise, guys, thank you for staying tuned. Please like, share, and subscribe. Bye bye.